Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we're going to take a look at the difference between borrowing in a limited company versus your personal name. Now, this is a conversation we have a lot, mainly aimed at should I be buying property in a limited company versus should I be buying this in my personal name? And that's a slightly different topic. What we are looking to do in this episode is just to understand the difference in dynamics between borrowing in your personal name and borrowing in a limited company. What does that look like? What does that involve? What's the pros, cons, etc.? So that's what we're going to unpack in this short episode. If that sounds like something that you're interested in, then please do stick around so that we can cover this off and hopefully you can take away some key learnings from it. And this will help you make a decision as to whether investing in a limited company is right for you, in addition to obviously whatever tax planning you may have in mind. So that being said, let's get straight into it. So mortgages. Mortgages are a main part of property investing. There are many people who have properties without mortgages, but frequently, if you want to get into property, then mortgages are the tool that help you get into property a lot quicker. That's the leverage needed to buy the assets in the first instance. So understanding how that works and what that looks like in both your personal name and a limited company is key to helping you make decisions around which direction you wish to take. Okay, so let's start then with personal names. If you want to borrow it in your personal name, so you own the property in your personal name and the mortgage is going to be in your name, okay, then the first thing to note is that that is a personal liability. Okay, what do we mean by liability? So that means that if anything were to go wrong with that property and you couldn't repay that loan, you would personally have to repay that. Okay, so that would be your own liability. Now, that can be done in sole name, so just one person's name. It can be done in joint names, 3 names, 4 names. There are limits as to how many names can go on applications. We tend to see individuals or 2 joint. Okay, so that's worth noting. And if it is in joint names, and you run into difficulty with the loan, the lender has the ability to approach both or each individual for the full balance. Okay, so if person A isn't of means to be able to settle the balance, then they can go to person B for the whole balance also. It isn't sort of 50% to one and 50% to the other. Okay, so that's important to note. Now, in reality, in a situation where you go into default or the bank has to repossess the property, then they will ultimately sell the property. And obviously, we're now talking about the difference between the loan and what they've been able to recover by selling the asset. So this isn't a full balance, or rarely is it a full balance. It's usually the difference between sale proceeds and the balance outstanding on the mortgage. Okay, so if you're in a low loan to value position, then the chances of that being a negative conversation are a lot slimmer than if you're looking to push it up to 80% loan to value, etc. Okay, so that's something to bear in mind. Also, when looking at your personal name, is to consider how you own the property. Now, whether that is what we call joint tenancy or tenants in common. Now, joint tenancy means that, let's say you've got person A and person B. In the event that anything were to happen to them, they were to pass away, then person B, the surviving person, would then get the property wholly in their name. Okay, joint tenancy is different in so much that person A and person B each own 50%. And if anything were to happen to either person A or person B, then there is decision what happens with their 50%. Okay, it doesn't automatically go across to the other party, and it will be usually dispersed, the ownership to children and that sort of stuff. More common in your ownership of your own home, but certainly something to note. It doesn't avoid the liability issue, okay, but it is something to bear in mind in that regard. The other thing on personal income is the affordability assessment on buy-to-lets. So if you are a basic rate taxpayer, you will have to, when we do the affordability assessment, we have to assess something called a debt service coverage. All that is what percentage over the mortgage payments is the rental income, okay? And that for personal basic rate taxpayers in your personal name is 125%, okay? So what we're saying there is if your mortgage is £100 per month, then your rent needs to be £125 per month to meet that criteria. If you are a higher rate taxpayer, that calculation is slightly different. It is 140, sometimes 145%. So that now means if your mortgage payment is £100, your rental income needs to be £140 or £145, okay, depending on the calculation. So that can have quite a bearing on the affordability assessment and the max loan that you can achieve, particularly on low yielding properties. Okay, so that's something to note if you borrow in your personal name, and we'll come on to how that differs in limited companies in a second. And then the last thing is ages. So the most lenders, well, every lender will have a maximum age limit. That obviously is going to be a limiting factor the older you are, and based on the length of time that you wish to borrow the money for. So that is usually around 80 to 85 years of age. So that needs to be a consideration as well. So moving on to limited companies then, how is borrowing within a limited company different? So the first thing to note is that the borrowing entity is the limited company. So it's not you as an individual borrowing the money. Despite you being the shareholder and director of the company, it is the entity that borrows the money, and it's the entity that owns the asset, okay? And you are the owner of the company, right? So the entity is borrowing this, not you. So that means that it is a company liability. Now, a limited company, given its by definition, is a limited liability. Okay, so that means a lot of people back in the day would open up a company. It would limit the liability solely to the company. So if anything went wrong, they would just wind it up. Nothing owed to the directors or shareholders. Nothing coming back to the directors, and they would just walk away. Okay, that is no longer the case because too many lenders or too many people who offered credit facilities to limited companies caught a cold over that, and there are no mitigants in place for it. But it's important to note that this is actually a company liability, and lenders have done things to make sure that directors also share in the responsibility of that liability, which we'll come on to in a second. Affordability is assessed differently. The affordability on this, the debt service coverage, which I mentioned on the basic and higher rate taxpayers, it is one figure for limited companies. It's 125%. Okay, so that means if your mortgage is £100, you need £125 of rental income to service that and tick the box. Okay, that you can satisfy the criteria for that. That is particularly useful if you're a higher rate taxpayer. As explained in the previous example around personal ownership, it's worth noting that 140% is going to limit your mortgage borrowing capabilities far more than 125%. So if you're a higher rate taxpayer, there are certainly advantages to owning or borrowing within a limited company from an affordability perspective. Coming back then to the liability side of things, what lenders have done, or what lenders now do, is they have something called a personal guarantee. So as the name suggests, you personally guarantee against the loan itself. So back to the scenario in the personal name, in the event of a default or repossession rather, the lender will recover the property, sell it, and then you will be liable for the difference in your personal name. The same principle applies now in the limited company. So they would recover the property, sell it, and then any shortfall would fall into the personal guarantee, which would then make it a personal liability. Okay. Now, because companies can have different structures, there may be 4 shareholders, 2 directors, 4 directors, 2 shareholders, etc. So shareholders and directors don't have to match. Then we can also shape what that personal guarantee looks like, depending on who's the beneficiary of the borrowing and so on and so forth. Now, It's rare that we get scenarios in property specifically where the shareholders and directors aren't usually the same people. But that doesn't always have to be the case as far as limited company structures are concerned. Okay. What that means is, from a personal guarantee perspective, is we have different types of guarantees that exist. So you can have something called a joint and several guarantee, which is the most common one. And that means that if Director A isn't of means to pay, then Director B can be wholly responsible for the outstanding balance. Okay, so it isn't, again, split 50-50 or in accordance with the shareholding. It means that they can go to either party to recover all of the money. Usually it's both, okay? There are guarantees out there. There are personal guarantees whereby we can limit the liability. So we can limit it to, say, 30,000, 40,000. And there are guarantees where it can be Director A will be responsible for this amount and Director B will be responsible for that amount. That is more common in the commercial space. Very rare if it is in standard buy-to-let. Again, they're very vanilla in the way that they structure these things. So you can expect a joint and several guarantee if there's more than one party associated to the actual loan itself. Okay, so this perception that borrowing a limited company means that it's the company liability is wrong. It will come back to you as directors as well because of the personal guarantee. And you can expect to get independent legal advice on it as well, which is an additional cost. So you need to bear that in mind also. Now, one of the good things with this as well is that limited companies don't have a life in so much that they don't expire. So that means that the borrowing age limits are less of a problem for limited companies. If anything were to happen to a director shareholder, then their shares would simply move across to whoever it is as per their will or their wishes and so on. So that is far less of a problem. Therefore, you can borrow into later life in regards to that. Often what the lender will look at is who is involved in the company and does that make sense? But it is certainly less of an issue. There are some lenders that have no upper limits as far as limited companies are concerned. Okay. The other thing as well with limited companies is you can be a little more creative or sophisticated, I should say, in your company structures, in how you structure your portfolio. And that can certainly help in regards to tax planning. It can also help in regards to succession planning or inheritance tax planning and the like as well. If it's in your personal name, you can obviously do certain things in regards to the property. If it's in a company, you can do a lot more in regards to group structures, layering. You can have different shareholders. You can start to bring children on at a different age. It's easier to give away a percentage of a company than it is to give away a percentage of an actual physical property. So there are benefits associated to that as well. Okay, so that's a quick overview of the difference between borrowing in your personal name and a limited company. Pros and cons to both. It depends ultimately what your objective is and what you're trying to achieve. If this is a tax conversation, you need to speak with your accountant because you need to get the requisite advice associated with borrowing and investing in property. That will differ from person to person and based on your individual set of circumstances. Again, if this is to do with a succession planning, you need to speak to the right advisors in regards to getting some financial advice to make sure that whatever you're trying to put in place is sufficient as well. So the point of this episode is simply just to explain the differences between borrowing in both your personal name and a limited company. Hopefully this has given you a bit of an insight as to the main differences. I'm sure there are many more, but these are the main ones that I've got written down here. So if you've got any questions of this or if it sparked any queries and you think that you need to chat through with us, you can find us our contact details in the show notes. And yeah, thanks for listening, guys. Really appreciate it. And I shall see you on the next one. Take care now.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.